Hi there, Brian here from the Cash Flow Desk. Today, we're diving into double entry accounting, the foundation that pretty much every business runs on, whether they realize it or not. If you've ever wondered why accounting seems so rigid, or why your bookkeeper insists on doing things a certain way, double entry is usually the answer. It's been around for over 500 years, and there's a good reason it's stuck. We'll cover what double entry actually means, why it works so well, and how it keeps your books accurate, even when things get complicated. So, what exactly is double entry accounting? The core idea is simple. Every transaction affects at least two accounts, and the books always have to balance. Think of it like this: money doesn't just appear or disappear. When something increases somewhere, something else has to decrease, or another account has to increase to match it. For example, when a consulting firm receives $5,000 from a client, two things happen. Cash goes up by $5,000 and revenue goes up by $5,000. Both sides of the equation move. Or picture a retail business buying $10,000 in inventory. Cash decreases by $10,000, but inventory increases by $10,000. The net effect: zero. The books stay balanced. This is what separates double entry from single entry bookkeeping, where you might just write down received 5,000 without tracking where it came from or what it represents. Double entry works because it's built on a fundamental equation that always has to balance. Assets equal liabilities plus equity. Assets are what you own: cash, inventory, equipment, accounts receivable. Liabilities are what you owe: loans, unpaid bills, customer deposits. Equity is what's left over, the owner's stake in the business. Every transaction you record has to keep this equation balanced. If assets go up, either liabilities have to go up, or equity has to go up, or other assets have to go down. Let's say a software company takes out a $50,000 loan. Assets increase by $50,000 in cash, and liabilities increase by $50,000 in loan payable. The equation stays balanced. Or imagine that same company uses $20,000 of that cash to buy new servers. Cash decreases by $20,000, but equipment increases by $20,000. Still balanced. You might be thinking, with all the accounting software available today, why does this 500-year-old system still matter? The answer is accuracy and accountability. Double entry creates a built-in error detection system. If your books don't balance, you know immediately that something's wrong. Maybe you recorded a sale but forgot to record the corresponding increase in cash or accounts receivable. The imbalance forces you to find and fix the mistake. It also creates a complete financial picture. You're not just tracking cash coming in and going out. You're tracking assets, liabilities, and equity changes. This gives you the data you need for real financial statements, balance sheets, income statements, cash flow statements. Without double entry, you'd have a hard time knowing your true financial position or explaining it to investors, lenders, or buyers. Let's walk through a few examples to make this concrete. Take an e-commerce business that makes a $2,000 sale on credit. Under double entry, accounts receivable increases by $2,000 and sales revenue increases by $2,000. When the customer pays a week later, cash increases by $2,000 and accounts receivable decreases by $2,000. Each transaction is captured completely and you can see the full story: the sale, the outstanding receivable, and the eventual collection. Here's another one. A service business pays $3,000 for 3 months of software licenses up front. Cash decreases by $3,000, but prepaid expenses increases by $3,000. Then, each month, prepaid expenses decreases by $1,000 and software expense increases by $1,000. This shows the true cost timing. The expense hits when the software is actually used, not just when it's paid for. Or consider a manufacturing company that takes out a $100,000 equipment loan. Cash increases by $100,000, equipment increases by $100,000, and loan payable increases by $100,000. 3 accounts move, but the equation stays balanced. There are a few misconceptions about double entry that are worth clearing up. One is that it's too complicated for small businesses. That's not really true anymore. Most accounting software handles the double entry mechanics automatically. You just enter the transaction, and the software creates the proper journal entries behind the scenes. Another misconception is that double entry is just for accountants. In reality, understanding the basics helps business owners make better decisions. When you know how transactions flow through your books, you can better interpret your financial reports. And some people think double entry slows things down. Actually, it often speeds things up in the long run because it catches errors early and creates clean, reliable data for reporting and analysis. Double entry accounting adapts well to modern business models too. SaaS companies use it to properly track recurring revenue, deferred revenue, and customer acquisition costs across multiple periods. E-commerce businesses rely on it to manage complex inventory flows, customer refunds, and multi-channel sales. Even cryptocurrency transactions follow double entry principles. When you buy Bitcoin, cash decreases and digital assets increase. The principles stay the same, but they scale to handle whatever complexity your business throws at them. The key is that double entry gives you a complete, balanced view of your financial position, no matter how your business operates. So here's the bottom line on double entry accounting. It's not just an old system that accountants insist on using. It's a proven framework that keeps your books accurate, catches errors early, and gives you the reliable financial data you need to run and grow your business. Whether you're doing the bookkeeping yourself or working with a professional, understanding double entry helps you make sense of your numbers and trust your financial reports. If this was helpful, give it a like and subscribe for more practical finance content. Drop a comment if there's a specific accounting topic you'd like us to cover next. Thanks for watching. I'm Brian, and I'll see you in the next one.